Hi guys. Today we will analyze Prudential Financial stock, and calculate its intrinsic value using two different valuation models. Enjoy! Hit the like button and subscribe to my channel if you want to see more videos like this. Technical analysis. The stock has been an average performer in the overall market. Also, recent evolutions are not positive. The short-term trend is neutral. The long-term trend is still positive, but the trend can change at any moment. Support levels are around $100 and $96.80. Next support levels are around $90 and $78. Resistance level is around $114. Strong resistance level is around $122. In the last month the stock has been trading between $102.60 and $122.50 range, which is wide. It is currently trading near the lows of this range. The stock has an average volume of 1.8 million. This is a good sign, as it is always nice to have a liquid stock. Intrinsic value. Buy low, sell high. We have heard it many times before. But how to know when it's low, and when it's high? The intrinsic value of a stock is its true value. It refers to what a stock is actually worth, even if some investors think it's worth a lot more than that amount. Intrinsic value is important, because it can help investors understand whether the cost of a stock is undervalued or overvalued compared to the market value of the stock. Intrinsic values calculations. Let's calculate the stock's intrinsic value. For more accurate results, we will use two different valuation models to calculate the intrinsic value of the stock. The excess return model. This approach is used for financial institutions where free cash flow is difficult to estimate. Then, we will use valuation based on earnings per share, EPS, 5-year average P/E ratio and expected growth rate. First model. Excess return model valuation. This spreadsheet contains some financial data that we will use for the stock valuation. In this valuation I will use margin of safety. 30%. Once we actually figure out what we think this stock is worth, we are only going to buy the stock if it gets 30% of what we think it's worth. It gives us a big margin of safety if our predictions are wrong. In other words, when something is worth $1, I want to pay only 70 cents for it. I want to be conservative with financial institutions. So, my margin of safety is 30%. According to our formula, the fair value of the stock is $132.87. When we apply the margin of safety to that value, the fair value of the stock would be $93.01. That's the price that I may want to pay for this stock. Second model. Valuation based on earnings per share. This spreadsheet contains another financial data that we will use for the stock valuation. The current earning per share price for Prudential is 12.32. Minimum rate of return. I will use 10%. Because when we invest in individual companies, we are looking for a higher return than the S&P 500. For Prudential, analysts forecast growth rate around 5% per year in next 5 years, and future P/E around 9. I will use 3 different scenarios for Prudential Company: bad, average, and good. First scenario. Prudential will have bad performance in next 5 years, and we will use the following parameters in our calculation. Future growth rate would be low, 3%. Future P/E would be low, 7. In this case, the fair value of the stock today would be $48. Second scenario. Prudential will have average performance in next 5 years, and we will use the following parameters in our calculation. Future growth rate would be average, 4%. Future P/E would be average, 9. In this case, the fair value of the stock today would be $67. Third scenario. Prudential will have high performance in next 5 years, and we will use the following parameters in our calculation. Future growth rate would be high, 5%. Future P/E would be high, 11. In this case, the fair value of the stock today would be $89. As you can see, today the stock is a bit overvalued, $103, even if we expect the company's high performance in future. The fundamentals are good, but Prudential is expected to show a small growth in revenue in the next 5 years. Nothing too spectacular is happening here. And the stock is currently a bit overpriced. I may consider buying the stock for the dividend, 4.66% yearly, if the stock drops below $90. Company strengths. Prudential Financial is an American company, whose subsidiaries provide insurance, retirement planning, investment management, and other products and services to both retail and institutional customers throughout the U.S., and in over 40 other countries. In 2019, Prudential was the largest insurance provider in the U.S. The company intends to invest in higher growth markets outside the U.S., and divest lower margin international businesses. Prudential has also grown assets under management, which generate higher year-over-year fee income. A rise in interest rates will help ease some of the downward pressure on margins in many lines of its business. The company's balance sheet is clean, and management consistently returns capital to shareholders through dividend hikes and share buybacks. The company has shown improvement based on our three main financial strength criteria of debt levels, fixed cost coverage, and profitability. Prudential has a profit margin of 11%. This is comparable to the industry average of 8%. With a yearly dividend yield of 4.66%, the stock is a good candidate for dividend investing. Over the past 5 years, dividend growth has averaged 8 to 10% per year. Risks. Some investors have been concerned about Prudential's deployable capital above and beyond the capital that must be reserved to pay claims. In particular, Prudential's aggressive buyback and dividend policies may strain deployable capital. Prudential investors also face risks related to uneven international growth and volatile equity markets. The life insurance industry is a competitive industry with unattractive pricing dynamics. Given the length of some contracts, it's unclear whether growth will ultimately be value accretive. Prudential's return on assets of 9.4% is worse than the rest of the industry. The industry average return on assets is 12.5%. The company is expected to show a small growth in earnings per share. In the coming 5 years, the EPS will grow by 5 to 7% yearly. In the coming 5 years, the revenue will grow by only 3 to 5% yearly. Thank you for watching. If you found this video helpful, please hit the like button and subscribe to my channel.